Hello, Okemo Valley. This is Carol Lighthall with Okemo Valley Chamber of Commerce Chamber Show. Today we're all about taxes, tax season, tax updates with my friend Jeff Graham of Graham and Graham.
Good morning, Carol.
Good morning. Thank you for being here. So I did a quick Google search just to, I guess, give myself some talking points about today's program. There's a lot going on with taxes, a lot of updates to talk about.
There are.
Before we get started, why don't we talk about, I wasn't aware that you have a very nice history with Ludlow, where we're shooting today. Could we talk about that?
Well, my grandparents and great-grandparents had farms in Plymouth, Vermont. That's now part of Farm and Wilderness. My dad spent quite a few summers there as a kid, growing up in the region from Springfield to Plymouth. I opened an office here in March of 1982, 37 years ago this week, actually. Practiced here from 1982 to 2006. At 145 Main Street, which is known as the Mill Condominium Complex.
Mm-hmm. Yes, yes.
And then decided to consolidate offices. And I still have a Springfield, Vermont office, but I sort of expanded into New Hampshire, in Laconia, and in Concord.
Great, great, great. So you talked about your locations a little bit. In terms of the business you do, could you talk about that and your specialties? And,
Sure.
And I would also add to that, since we're right in the midst of tax season, I really appreciate you taking time out from your hectic days to be here to chat with us.
Well, there's nothing like having to fit it in between schedules of other kinds, so thank you. So what do I graduated from Springfield High School in 1976. That leaves me at about 60 years old. I went to Plymouth State College in New Hampshire and graduated with an accounting degree. Started my accounting degree work at Dufresne Henry Engineering in Springfield, Vermont, where I've met a lot of really cool folks, some of which are from here in Ludlow. The practice actually is three different kinds of practice. It's an income tax practice for sure. That's about a third of our work. We issue financial statements and do a lot of things with companies and businesses that need to have things done that require financial statements to be issued as the third party, which is what we do. And then we have this niche market that is full of things like business valuations and fraud investigations and estate and trust and probate work and just general consulting for businesses and individuals. And our crew is about 10 people, and we spread ourselves between Vermont and New Hampshire, but we have practice privileges and licenses in other states and spend a little bit of time outside of Vermont or New Hampshire doing work for really cool people.
And I see you are involved now and then. I see you in the newspaper as a expert witness.
I do, yeah. So the expert witness stuff started back in my days in Springfield with Doug Richards, who kind of got me into the business. He was a lawyer in town and needed to have some financial stuff. And I started out as a fact witness and then became an expert witness. And over the years, I worked for some really cool places and people like the Department of Justice and the FBI and the Secret Service and some state police related investigations, and have a little bit of experience doing that and probably a lot on the stand. I think I've worked for about 125 law firms in my career and been on the stand probably about as many times as that. It's certainly not for the faint of heart. You kind of get up on the stand and know you're going to get hit a few times by the opposing lawyer, and the court system is a really interesting place to practice and has its own set of rules and respect and obligations, and I like doing it. It's a big challenge, and not many of my peers like to be up there, so I get quite a few opportunities to do that.
Yeah, great. That's so interesting to me. I'm going to throw my glasses on because I want to just make sure I'm talking about the points we've talked about. So it sounds like the tax reform bill of 2018 is what we're dealing with in this year's tax season.
Correct, yes.
And so from what I read, it was called Tax Cuts and Jobs Act.
Correct.
And it said less money would be taken from the paycheck. Are you seeing that in practice?
We are, and it's a math problem. It's been a lot of national news about the fact that refunds are lower, but if you think about what happened on January 1st, 2018, the tax tables changed. And the tax tables actually reduced the dollar amount of federal and state tax being taken weekly or every pay period out of everybody's earnings. So if you get it each week or each pay period during the year, mathematically you're going to have less at the end of the year. So in concept, it was an economic policy to put more money in people's paycheck to then go spend that money on things that they need during the year. And at the end of the year, they would certainly expect less of a refund or have a larger balance due. But it was meant to sort of be the impetus for every week or every pay period having more money to spend on purchases and services and things that would help our economy. And I think there's been some change at the end of the year with people who expected a larger refund. But in general, we've done about 225, 230 returns already. There's not a big difference in our client base, and we have a pretty widespread type of client, income levels and numbers of children and people in college and 1 and 2 earners. So I think we've seen a good cross-section to know that, yeah, there's been some change, but there's a change every year.
And you talked about how many tax returns you've done, or you generally would do, and it's a huge number.
Yeah, we do about 600 during the filing season. We'd probably do about 800 in total among all 3 offices. And I've been doing this 40 years, so I figure I got about 20,000 tax returns under my belt. And
wow.
this is definitely the largest change in the tax law since 1986. The forms I have in front of me look entirely different than they did last year and the years that I've been practicing. It's not really much of an input change for us. We look at the same screens and put the same information into our computer program, but when you spit it out and it's a tax return, it looks very different. So if you haven't seen it yet, it's kind of an interesting document.
Great. And so what is, just looking at this, what are the key differences on here?
You literally could take one page this year, sign it in the middle of the first page, the 1040 page, have all of your consolidated information on the bottom 50% of the page, and send that one page in.
Yes.
That's not always the case, but we've sent in a couple of dozen returns with literally just one page being the only thing that was required. In the past, it could have been several pages, and it was at least 2 pages of a 1040. Now it's really 1 page of a 1040 with all of these other schedules that are attached to it.
Yes.
So there's a schedule for non-refundable credits. There's a schedule for other taxes. There's a schedule for other payments and refundable credits. There's some foreign address type things that they want. There's additional income and adjustments to income, and then the tax section. Those used to be part of page 1 and page 2, and then subsequent pages that were attached to prior returns. Now you just get this one page. In many cases, you can just sign it and send it in, or have it electronically filed with that one page.
So it sounds like you're saying people are generally able to keep more money in their paycheck, and the process seems a little bit simpler than it was. More straightforward, is that accurate?
It is, and my assertion out of this, assumption out of this, is the IRS really doesn't want to do a lot of audits, or the state of Vermont or the various other states don't really want to spend manpower, human power on audits. So they've created a series of standard deductions larger than they were before to make it easier for them to process returns, to make it easier for them to not have to audit returns, and to take away a little bit of the temptation of taxpayers to exaggerate what their deductions were, lower their taxable income, those sorts of things. And by doing that, the return itself can be smaller and shorter, not as many things to have to pull together when you're preparing your own return or when you're having somebody else do that for you.
Mm-hmm. Excellent. And so there's a number of changes that have happened this year. Should I ask you questions, or would you like to just jump in?
This is your show. I'll do whatever you want.
So I would just say maybe you'd talk about the tax brackets and marginal tax rates.
Okay. So in the past, you would get the standard deduction amount and the personal exemption amounts free of tax. So roughly $12,000 to probably $20,000, depending upon your family size and whether you're married, filing a joint return or not. Now what's has happened is the personal exemptions have been removed totally. Those were roughly $4,000 per person on the tax return. Those are now not even on the return. Instead, you get a standard deduction, which is much higher. So if you're a single tax filer, you get $12,000 of free income. If you are a head of household, meaning you have a child that lives with you that has a certain age group and that would be an $18,000, first $18,000 free of tax. And then if you're filing a married filing joint return, that's $24,000. So some people were benefiting from that, and some people have not benefited from that. And typically the people that would not benefit would be a large family. So they used to be able to get their standard deduction and $4,000 per person. Now it's just $24,000 for married filing joint return. However, I use the analogy of the teeter-totter. If the taxable income goes up because of that, the benefit really in this tax package is the tax rates have gone lower. So there still is a 10% tax, but instead of have a 15% tax, we now have a 12% tax to replace it, and the dollar amounts that you can earn within that tax bracket have widened. And instead of a 25% tax, it's now a 22% tax, and the same issue. The dollar amounts that you can earn within that bracket have actually widened and become larger. So if you have a higher income but a lower tax, they tend to come back towards almost no change. And that's what we're seeing is not everybody fits into that exact bracket and that type of scenario, but it's pretty common for us to see that. Before the season started, we took our 2017 tax returns for about 12 very different looking taxpayers in our client list, plugged them into the 2018 tax package and said what happened. And very few had any change at all. And the higher earners actually had a little bit higher tax bracket, and the people with lots of children that were under 17 probably got a larger child tax credit, but got fewer personal exemptions. So there's all those things we're going to change every year anyway. This is just a bigger change. It happened in 1 year instead of a series of things that happened over a series of years.
And so, and it sounds like if it's important for people and families to have a return, refund, that they need to make some adjustments. Is that what you would suggest?
It's a great idea to go to the payroll department of where the person works, or to figure, if they work for themselves, figure out themselves what they should have for what table, which table to use. So there's a table for married and there's a table for single. And it doesn't mean you have to be married to use the married table or single to use the single table. What it really means is there are several columns of numbers. And if you pick, for instance, married 0, you're going to have slightly more money taken out than if you picked single 1. And so you could go to the married table and figure out what your tax liability is for the year 2018, divide it by 52 weeks if you get paid each week, and figure out what table to go to and what number to pick from that table. Married 1, married 2, married 0, whatever it might be. So going to the payroll department, asking your HR people, or at least asking somebody for help on figuring out what to put on your Form W-4 for exemptions, and the table to use is a really important piece now. And if somebody's already done their 2018 return and found that they had a different result than they wanted, now is the best time early in the year to go and change those deductions in that table.
Excellent. And so some of the other kind of big changes, mortgage deductions, home equity loans, maybe you could talk about both of those?
Sure. So both of those have dates in which nothing happens. So before December 15th, 2017, if you already had your mortgage, there's no real change in the dollar amount that you can take on your tax return for mortgage interest expense. And the home equity loan, originally in the early explanations of the tax change, said home equity loans would not be deductible. They've since come back and said, technically, if the home equity loan was used specifically on your property, that it still can be used as a mortgage interest deduction. It's just that you can't take a home equity loan and use that borrowing for, say, a college loan instead. If you used it to borrow money for your child's college loan, college tuition, you would not get that deduction. But if you used it to add an addition to your house or replace the roof or something major like that, as long as it was based on lending for that house, you still get the same deduction that you always did. If, however, you have a mortgage after December 16th, 2017, the new rules are the mortgage interest can only be calculated on the first $750,000 of mortgage. And if you have more than that, you have to start prorating the dollar amount that you can take on your return. So they started to build in some threshold limits and to make sure that it's a fair, equitable system. I'm not sure it will ever be fair and equitable, but that's the concept. I remember my college professor, Professor Church, saying, if there's nothing else that you take away from this tax class that I'm about to teach you while I was in college, it's that taxes are a combination of social and economic policy. And the social policy changes and the economic policy changes yearly, certainly by administration to administration. And along with those changes will come changes in those social policies and those economic policies. And you see the result of that on a tax return. So I've never really been upset about tax returns changing because I just figured that that was what was going to happen, period. And we call it the Accountants Employment Act. It's a way that we actually have people come and ask us questions. So how could we be upset about that?
Excellent. Well, and so I read something interesting about charitable donations, that there's actually an increase.
Yes.
If you could
So
touch on that.
In past years, there were two different designations. One was, is the entity a qualifying entity for up to 50% of your adjusted gross income as the deduction? And then if it wasn't a 50% deduction of adjusted gross income, it was a 30% deduction. Now that number has changed from 50% to 60%. And in concept, if you have a person who's done well in their life or feels a great need to make charitable contributions, they just have to understand that at some point, the benefit on that year's tax return will stop. And that's what the 50% rule and the 30% rule and the now 60% rule talk about is, at some point, you have to stop taking the benefit of a charitable contribution in that particular year. And if you have to stop, the money that you don't take as a deduction in that year, you can carry forward into subsequent years and take it and apply the same set of rules. And as long as we're on the subject, a Vermont change, which I think is a really nice change, is if your charitable contribution qualifies on your federal tax return, you can take a 5% credit against Vermont tax for making those charitable contributions. It's a brand new practice and brand new policy of the state, and I think it's following along the lines of they would like to have older Americans be in Vermont, stay in Vermont or come to Vermont, and maybe start to change the impression of Vermont having one of the highest rates of the entire country for state income tax. So this is one of the two ways that they have started to change the Vermont tax law. The other one being Social Security, depending upon your income level, is not taxable at all, or is starting to become taxed at dollar amounts much higher than zero. So it's another way for elder Americans to stay in Vermont or to want to move to Vermont if one of their concerns is tax rate. So it's another huge benefit, another huge change. I've never seen it actually ever in Vermont before. A few other states actually have it, but Vermont has never been one of them. So kudos to Vermont for trying to keep people here.
And so, in the Social Security change is that Vermont is not taxing that income, or?
Correct. So the hypothetical, the actual is that you put it on your federal return. Up to 85% of that federal Social Security payment could be taxed. But when it's transferred over to Vermont, there's an exception, an exclusion for Social Security that was taxed on your federal return, and it really is income based. And so we have to go through the calculation of figuring out whether their income was low enough before Social Security to have none of it taxed, or if they start to have a portion of it taxed depending upon how high their income has actually gotten. So it's just a math calculation, and it's a formula that's right in the easy to calculate actually to figure on whether you're going to have to pay tax in Vermont for the Social Security payments.
Mm-hmm. And so are other states doing the same thing?
A few do. A few have had them in place for a while, but this is new to Vermont.
Mm-hmm. And how about medical expenses? How has that changed?
So for years, medical expenses had a threshold, and that was 7.5% of your adjusted gross income. And if it was over that, then you get to take advantage of that by increasing your itemized deductions, which reduce your taxable income. Last year 2017, it went to 10% for anybody under the age of 65. Now for everybody, it's gone back to 7.5%. So in many cases where people have spent a lot of their disposable income in medical areas, they've found that the raising of the threshold, a percentage and amount, was hurting their tax refunds and their balances due. So I think another one of those economic and social policies was to help those folks who are spending a lot of money in medical to actually not have as big a tax burden. So that certainly is a big change, both on the federal side and the Vermont side for this year.
Thank you. Now, we've not talked about impact to business taxes. Is that something you can talk
I
about?
can.
I'm sure it's not just simple.
It's not simple, but I can tell you there's this brand new term and a brand new concept, and it's called qualified business income, QBI for short. So the federal corporate tax rates for filers that we refer to as C corporations. So General Motors is a C corporation. It pays tax on its earnings and then distributes dividends out to its owners. Other than that, there are other kinds of business operations called S corporations, like subchapter S of the Internal Revenue Code, or partnerships or limited liability companies. So in those cases, they weren't going to get the benefit of the reduced corporate tax rate unless Congress did something to change that. So they came up with this concept and this tax regulation called QBI, Qualified Business Income. It's a really long discussion about how to actually calculate it, but just know that up to 20% of your business income gets a deduction off your taxable income before you have to calculate the tax. So hypothetically, to make it easy on me, I have a $10,000 profit from my business operations. I could potentially have $2,000 of those dollars not taxed at all to make sure that the non-corporate taxpayers in business are paying the same rate as the corporate taxpayers are in business. And that's the concept behind QBI. There's a long mathematical calculation to go through, and it depends on what kind of business you're in, whether you provide services, whether you provide widgets and products and other kinds of things. And in some cases, rental property for people who are very active and consistently active and stay in that business line. Also, rental property profits can be eligible for this QBI deduction. Never in the series of tax returns that I've worked on in 40 years has that been considered a business operation other than a passive business operation. They're now considering those folks who have that kind of business operation to be an active business that would be eligible for this 20%, up to 20% credit, which is, not credit, I'm sorry, deduction, which is a really big deal. When you start thinking about the monies that are paid out for entrepreneurs, that's a very big incentive for them to stay and to use that money for something else.
And invest in real estate, sounds like. Is that?
It certainly would help the real estate
Yeah.
investment market to have more people in who thought that they could earn a certain dollar amount and only have to pay tax on 80% of it, if that's the case.
Yes, yes. So what else should we touch on that we haven't talked about quite yet?
So another big issue, since there are a lot of Vermont and a lot of the nation is divorced, is alimony. Alimony, if you have an alimony agreement in place before 2018, the alimony still can be deducted by the payer, and it still is taxable to the spouse that's receiving it. But in the future, 2019 and after, that won't be the case. And if anybody had an active alimony agreement or a maintenance agreement in place, and it got changed during the year 2019 or after, it means that that also would fall under the new rules. So for a lot of our clients and a lot of people in the country and the state, alimony deduction and alimony having to be included in income is a very big deal. So that's a big plan. They've changed that. Moving expenses. So if you moved for job-related move, and that move meant that you had to move 50 miles or more to a new location, the costs associated with that move were deductible right from gross income before you pay tax. Now that's totally gone away unless you're a member, an active member of the armed forces, and you have a move related to your move for the armed forces. The standard deduction we've already talked about. One of the other new credits is it's like a family-related additional $500 credit if you have a mom or a dad or a cousin or a sister or somebody, niece, nephew, grandchild living with you, and they otherwise wouldn't be eligible to be considered a dependent. There may be a $500 credit against the federal tax for that change. The child tax credit is a very big deal for parents. If they have a child under 17, it used to be that credit was $1,000 against their federal tax. It's now $2,000 per eligible child against their federal tax. So that whole teeter-totter thing changes. If your income is higher but your credits are higher, then that typically would be a big issue for parents to know. Health insurance is still an issue, and there's definitely a difference between state health insurance rules and federal. So in 2017, at the tail end of the year, the president said we're not going to have a requirement to have health insurance, and we're not going to charge the penalties on health insurance. Well, that actually extends through the end of this filing, the 2018 filing. Starting in 2019, there are no penalties federally for not having health insurance. Vermont has come out and said we still want to have health insurance for everybody in the state, so there is a health insurance mandate here. But there's currently, as we sit here and talk on the TV, there is no Vermont legislation to actually charge a penalty. They have left it open in the information that we've seen so far that says we still can charge a penalty if we deem that to be important to the state. So between now and May, we'll figure out whether they've said, yes, we're going to charge a penalty, or no, we're not going to. Energy credits are more restrictive unless you are doing certain things like heat pumps now have some grasp on the community as opposed to fossil fuel. So we're trying to get away from fossil fuel and towards renewable energy, things that could be of interest in the tax code. So those would be things to take a look at.
So alternative energy kind of things like a heat pump have had both a little bit of a state credit, right?
Correct, yep.
And then a 30%, I
Federal,
think?
yes.
Federal. How has that changed?
So there's a bunch of the other kinds of credits have started to drop off. And so the focus right now, as I see it, is the renewable energy credits are very popular and active on the tax code. The other stuff that would be fossil fuel or burning of wood or pellets are not as popular. So those credits have changed. And I think that would probably be the focus for maybe the next few years in this administration, is to have those sort of go away for credits and to have a greater incentive for renewable energy investments in your home.
Great, great, great.
One big issue for business owners and for property owners is something called like-kind exchanges. And a like-kind exchange is very much like a trade. I have a vehicle and I'm going to trade vehicle 1 for vehicle 2. That's personal property being traded, which is different than a house. So if you're an investor in real estate and you want to get rid of house number 1 and purchase house number 2, if it's investment property, there's this concept in this tax law that's called a like-kind exchange. And it means that you want to trade property 1 for property 2, and you haven't come to the quote-unquote end of the earnings process. So it has been allowed in the past, and it still is allowed now, to trade property 1 for property 2 in this very complex setup where you can actually defer your gain on the profit from house number 1 into the value of house number 2. And that's very important to somebody at the end of their life when they want to get rid of a commercial property. They don't want to pay tax on it. And then when they have the second property, they can pass away, give that property to their family, and then that family would get what we call a step up in basis. It would go from its cost to its fair market value in the hands of the heirs. So real estate still has like-kind exchanges, but personal property, those trucks that are traded, or the tractors or the excavators, those now are completely different in that you have to pay tax on the gain on the sale of number 1 before you buy number 2. So I think it's really going to put a lot of emphasis on the real value of that property being traded or that property being sold, so that it's not inflated so that the person selling it has to pay an unusually large dollar amount of tax. I think there's going to be a lot of negotiating and discussion between the buyer and the seller and dealers and buyers on that whole topic area. Some business entertainment, expenses have gone away. Used to be able to go buy tickets to the Red Sox and the Celtics and take your clients to those, and those are gone. So a lot of other expenses of traveling for your work are still deductible, but that's not going to be one of them. Around here, where VRBO and Airbnb are very popular, and people are renting their properties, they should know that the first 14 days of rental, if that's all they rent is 14 days or less, are not taxable at all. You don't have to put those onto a rental schedule. If, however, day number 15 has a rental, all of those days are then taxable. They have to put those onto a rental schedule. But certainly if it was just a reason to rent your house for a week or 2 while you were gone someplace else, that would be one of those other incentives that stayed with the tax code. You can still do that. And
so that's over the course, when you talk about 14 days, Is that over the course of a year?
Yes,
Okay.
yes. They don't have to be consecutive. They just can't be more than 14 in order for that to be that way. The other issues, I don't know how much time we have left, but education is a big deal for a lot of parents and grandparents. So there are some 529 plans, they're called, and there are some education credits on the federal level. There are a lot of provisions now in the new code to allow swapping a 529 plan for child number 1 to child number 2, 3, or
Wow.
4. So some of those are important to parents who have put, or grandparents who have put away money for their next of kin, and first child either didn't finish or didn't need all that money, and then what do you do with that money? You don't want to pay tax on it. So if you have other children in your family, you can trade them to the other family with some rules that apply. Excuse me. And then Vermont. Vermont returns are very different looking, and there are a few provisions in Vermont returns that look more like a federal return than a Vermont return. I'm starting to lose my voice here. Excuse me. But just know that Vermont has new taxable income numbers that were never really taxable income before. You basically took the federal adjusted gross income number and paid a Vermont tax rate on that. Now we're basically making Vermont its own tax return, where we've got personal exemptions back again, we've got standard deductions back again, all those things that were typical for a federal return that were never really counted on the Vermont return have now become mandatory on a Vermont return. And my understanding is the state tax department and the legislatures wanted a better handle on what it used to be like so that they could bring those rules into current years to be sure that they knew what their tax revenue stream would be. Excuse me. Tax rates in Vermont have dropped along with the tax rates dropping on the federal, and we've already talked about the Social Security exemption. So I think I've covered all of that, except the last one in Vermont is a very new thought, and it's another way to bring people into our state, and it's the new remote worker grant. So if you move into Vermont after January 1st of 2018, and you are a telecommuter, meaning that you work from home for a company outside of Vermont, the state will grant you up to $5,000 per individual per year with a maximum of $10,000. So two spouses come in and they want to telecommute to New York or Massachusetts or wherever, and they've moved into the state after the 1st of January of 2018, they would be eligible for that Vermont credit. It's worth noting that it's a credit against taxes that would be owed. So if you only have a $2,000 per year Vermont tax, it might take you 2.5 years or 3 tax returns to actually get the benefit of that $5,000. It's not like they're going to give you that cash.
That's really interesting. So I hadn't realized it was a credit on your Vermont taxes.
Yes.
Now, I think that there's an approval process.
There is.
there? So before you can claim it on your taxes, you have to go through a process.
The Commerce and Community Development Agency is requiring an application to be able to do that, yes.
Yeah, that's exciting. Good to hear.
So the other piece in Vermont that's important to most taxpayers is the property tax rebate program.
Yes.
So the program itself is still active, but the dollar amounts of income and the dollar amounts of your property value have dropped. So it used to be a much higher dollar amount of income and a much higher dollar amount of property value. Property values went from $500,000 down to $400,000. So you can only calculate the benefit on the first $400,000 of value, and you can only calculate a tax savings on the first $90,000 of income. That number was $225,000, I think, last year. So very big drops in both of those areas. They also now are pulling apart the $8,000 credit into 2 components. They're using an income component and a property value component, which is why they have those 2 numbers separated, the $90,000 and the $400,000. So it's $2,400 for the income component and up to $5,600 for the property value component. And that calculation just got more difficult because you might have been eligible for the full $8,000 before. You might be not eligible for the full $8,000 now just because of the dynamics in your tax return. So it's still very active. It's still something that's very important to the state and to everybody locally in the whole process of funding education. But it, like everything else, is going to change over a period of time. So I think that covers most of my topic areas. I don't know if you have others that you would like to address.
Let's see. I think you've answered my questions. Just maybe final thoughts on your advice to people going forward with their tax returns. How to keep their house in order.
So it's a requirement to keep your records for up to 7 years. The 3 years before this year's filing are still open until April 15th. So if you found that there was an error on your 2017, 2016, or 2015 return, you still have some time to make those changes. It might mean that you owe them some more money. It might mean that you get a refund back. So look at your prior year's returns and see if you counted everything that you should have counted for a deduction, placed all of the income in there that should have been placed in there, taken advantage of all the credits, all that sort of stuff. We usually do that when we see returns for the first time. We just try and make sure we understand what they've done in the past. But that's an important piece. So just remember that the 2015 year is about to close. So you can only make changes between now and April 15th of 2019 for a return that you filed in 2016. That's that 3-year period.
Yes.
The other 2 years will be open for 1 more year and 2 more years. So you have some time, but it would be a good idea to look back at those. Keep records. It's now possible to not keep the physical record, but to keep electronic records. So you could keep it on a server, you could keep it on a hard drive, or whatever you wanted to do for those items from past years. But you should certainly keep those records. In terms of what to keep, it probably would be a good system to understand what you like to do to lower your income taxes. So if it's business deductions, keep all your receipts, have mileage logs. Theoretically, they're supposed to be contemporaneous with use. That's the way you get the deduction if you do that, if you ever had an audit. If you have other business records, you should keep payroll records, you should keep the actual invoices, you should keep all the bank statements, all of the vendor information that was sent to you, any 1099s you received, any W-2s you gave to others. So all that's, from a business perspective, very important. And on the personal side, child care expenses, you should keep a record of what the child care provider says you paid versus what you did pay. We certainly see those numbers are different quite often, and it's a struggle between the two parties to figure out who's correct. So it might be a good idea to take a look at that every year. And now with Vermont being sort of segregated from federal, it'd be a really good idea to understand that some things are not deductible on the federal return that are deductible on the Vermont return, or vice versa. So in planning the withholdings that you have, and you go use your W-4 to figure out married zero, single zero, whatever it might be, you have to understand there may be some credits on the Vermont side that are not available on the federal, or vice versa. And so you'd have to plan a little bit in advance to figure out whether you're going to have a refund or a balance due. Not everybody likes to do that, but it's an important piece. When you get to the end of the year, that surprise of having a really large refund when you thought you could have used that money during the year, or having a really large balance due. It's really important to understand what could be taxable to you. If you have lottery winnings, they're going to be taxable to you. If you have some sort of a gain on a piece of property that was sold that was somebody else's long before you and you sold it, it may have a large gain associated with it and a large tax bill. So those are the kinds of transactions that would be important to understand. If you find that you have one and you don't know whether it's taxable or not, you could always make a phone call. Google's a great product, still is very reliable. Certainly not our authoritative source, but it's a place that we would go to for general information a lot. And taxpayers can do that as well.
Yeah, great, great. Really good information on changes to both Vermont and federal tax process, forms, taxes, and so on. This is Jeff Graham, CPA with Graham & Graham, offices in Springfield, Concord, and Lebanon. Laconia. Sorry about that. And all this information reminds me that if I have a question, or if you have a question, turning to somebody that knows the answer, because it's a complicated subject, is really a good idea. Thank you for joining us.
Thank you for having me. I appreciate it very much.
And so that's all about taxes, and that's all for now. Thanks so much.
Thank you.